Hey everyone, today we're going to talk about restricted stock units and more importantly, strategies that you can implement around your RSUs to potentially save money on taxes, keep more money in your pocket, and give less money to Uncle Sam. Now, restricted stock units are, for the most part, very easy to understand. You get granted restricted stock and you pay tax on it when it vests. That's it. But don't let the simplicity of restricted stock units let you look past some opportunities where you can save money on taxes. So I'm going to discuss 3 things that you can do to defer taxes and potentially save money on tax and push tax to a year where you may be in a lower bracket. And then I'm going to link to a blog post below this video that I recently wrote that's going to cover 2 additional strategies that you can think about using if it fits within your financial plan. So let's get started. Number one is to maximize tax deferred contributions. Now you probably contribute to your employer 401k plan, and that money is pre-tax, which reduces your taxable income in the current year. So if you're not maxing out your employer sponsored plan and you have restricted stock units vesting in the current year, there's an opportunity here. So RSUs are subject to what's called ordinary income tax when they vest. So what you can do with this is actually use the proceeds to fund pre-tax accounts. So what kind of accounts are pre-tax accounts? Well, you have a traditional 401k, such as the one you contribute to at your employer, traditional IRA, and an HSA, one of my favorites. So using RSU proceeds to fund pre-tax accounts essentially serves as a tax offset. See, the tax liability on vesting RSUs balances, and it is balanced by the tax reduction when making pre-tax contributions. So that's one thing that you can do. Number 2, you can also use capital gain arbitrage. So you've already paid tax on vested restricted stock units in previous years. So this is for those that may have let RSUs vest a couple years ago and you're still holding on to employer stock. So when RSUs vest, the stock becomes subject to either short-term or long-term capital gain rates. Long-term capital gain rates are much more favorable than ordinary income rates. So by holding the stock for more than a year after vesting, a year and 1 day, and you have gains above the basis or the amount that it vested at, those shares are now subject to long-term capital gains as long as they have a gain. So you can get that in the 0, 15, and 20% bracket, which is, like I said, much better than ordinary income tax. So what you can potentially do here is sell shares that are at long-term rates, so let's just say 15%, and then use those proceeds to fund pre-tax accounts. Similar to the example in number 1, except this time we're using the proceeds from long-term capital gains to fund those accounts. And the way you do this is you basically just sell these shares in your account, but then you have to increase the contributions on your employer side. And in the back end of things, it balances out when you file your taxes. And the last one, number 3, bunch your deductions. So this is for those that may already max out all other pre-tax accounts. So bunching basically means, well, first off, let me back up. Most people are going to use a standard deduction, which was obviously increased by the Tax Cuts and Jobs Act. But bunching deductions simply means that you're going to put as many deductions in 1 year. So you may bunch 2 years of deductions in the same year to get a higher deduction than the standard deduction that we're most familiar with. So the way this works with RSUs is if you know that you're going to have a large amount of RSUs that vest in a certain year, it may make sense to proactively plan some kind of bunching strategy, and this can increase deductions and help minimize that tax effect that's going to take place whenever your RSUs vest. Now, some of the things that you can bunch is property taxes although that deduction's capped at $10,000, you can bunch charitable donations and medical expenses above 10% of your AGI or adjusted gross income. And you can bunch as many of these as you can together that apply to you. So those are 3 things that you can use to strategize and potentially save money on your restricted stock units. As I said, there's 2 more that are a little more complex that I'll link to the blog post where all of these strategies are included, plus the additional 2. And hopefully it helps you put some thought around your RSUs to where you can save money on taxes and keep more money in your pocket.